Okay. So the next standard that we're going to study is IAS 10, events after reporting date. Okay. Clear?
Mm-hmm.
So events after reporting date is when you have actually prepared your FS. All right. You have prepared your FS, but it is not authorized for issue. That means it's not signed off. Clear?
Mm-hmm.
Okay. So there is 2 points. This is when you have actually, when your accounting period ends. For example, 31st December. Clear?
Mm-hmm.
Okay. And this is when your FS is going to be published. Let's just say April 10th. Clear?
Mm-hmm.
Okay. So in that case, in this, that is between this time span of preparing the FS, just a moment. Okay. So these two time period, that is your year end, okay, and the date at which your FS is going to be published, right, or signed off, okay, or when
Mm-hmm.
it is authorized for issue, let's say, okay. So in between this time period, some things happen, right? And
Mm-hmm.
it could be both. It could be favorable, it could be unfavorable, okay. So
This
that sort
30.
of, yeah,
Mm-hmm. Period, which one? 31st
that is,
December.
this is the 31st December year end.
Mm-hmm.
This is April 10th, that is after the year end when the FS is going to be signed for issue. Clear issue means it could be available everywhere. Understood?
Uh-huh.
So in
Mm-hmm.
between that time period, some things might happen. Okay. And that
Mm-hmm.
thing can be a favorable one. Okay. And it can be an unfavorable one. Okay. And that events are called as adjusting or non-adjusting events. Understood? Or events after reporting date. Understood? Events
Mm-hmm.
after reporting date as in after the 31st December. Okay, you can rewatch the recordings again once it is done, once it is released. All right.
Mm-hmm.
Now, there are two types of events. One is adjusting and the other is non-adjusting events. Okay. So adjusting events are those events which, if happens, you have to adjust your financial statements accordingly in order to give a true and fair view. Clear, no? Okay.
Mm-hmm.
And non-adjusting events is when something has happened, but it doesn't matter. Okay. So for non-adjusting events, you don't need to adjust your FS. Okay. So that comes in two forms. Okay. Whether or not this particular event actually concerns your business's going concern. That means if it makes your business stop, that is the going concern issue. Clear? So we need to clearly understand whether it is going to affect the going concern concept or it is not going to affect the going concern concept. Understood? Okay.
Mm-hmm.
So if it is affecting the going concern concept, then you will say that the FS needs to be on a breakup analysis. That means you have to provide the liabilities first and then the asset. Clear? That is
Mm-hmm.
called breakup basis. And if it does not actually affect your going concern, then there is no adjustments done to the FS, but you're going to disclose it by a note. Understood?
Mm-hmm.
Okay. Now, the adjusting events, there are certain examples that is given. The settlement after reporting date of a court case, which confirms a year and obligation. Okay. So after the reporting date, some court case that started before the year end is finalized. Then you have to adjust your accounts. Clear, no?
Mm-hmm.
Okay. Second one, the received information after the reporting date that indicates that the asset was impaired at the reporting date. So you have an asset in before the year end, okay? And after the year end, that asset's value got less. That is impairment. Clear, no? So if there is an impairment like that, you have to adjust, come back and adjust the financial statements. Understood, no?
Mm-hmm.
Next is the bankruptcy of a customer after reporting date that confirms that a year-end debt is irrecoverable. So we have recorded some receivables. After the year end, we came to know that that customer has actually gone bankrupt. Clear.
Mm-hmm.
So this was, you were ever aware of this before signing the FS. So that means you are aware and it is an existing event. Clear?
Mm-hmm.
Next is the sale of inventories after the reporting period at price lower than the cost. See, for inventories, we have a rule, right? The IFRS says that Inventory, that is the closing inventory, should be valued at lower of cost or NRV, right?
Mm-hmm.
So if the selling itself is very low, then that means the NRV is lower than the cost. So we have to update the amount of inventory or value of inventory again. Clear? So that is an adjusting event. Next is the determination after the reporting date of the cost of asset purchased proceeds from the asset sold before the reporting date. Okay. So at the reporting date, if there is any assets that is being purchased or any asset that is being sold that needs adjustment, we have to do it. Clear now?
Mm-hmm.
Next is after the year end, you came to know of fraud or errors that is being committed in the financial statement elements. Okay, then that needs to be adjusted. Clear now?
Mm-hmm.
Now, the examples of non-existing events that could be tested in your exam is that it could be a theory question, all right? It could be it could be an MCQ and a theory MCQ. Understood? They would
Mm-hmm.
specify a certain situation where something was happened, and you have to decide whether or not it is an existing or non-existing event. Understood?
Mm-hmm.
Okay. Now, examples of non-existing event. Okay. So after the year end, you have your company has decided to discontinue some operations or discontinue some product line or discontinue the company itself. Then it is a non-existing event, but you would give a disclosure. Understood?
Mm-hmm.
Next is after the year end, you have actually purchased a lot of assets. Then that means it is a material thing, but you don't need to adjust it in the FS because it doesn't belong to current year, but you're going to disclose it. Clear now?
Mm-hmm.
Okay, disclose it as a note. Next is the destruction of assets after reporting date by fire or blood or flood. Sorry, unless the extent of loss is such a way that the entity may not continue as a going concern, in which in which case the basis upon which the financial statements are prepared may need to be questioned. Okay, so suppose after the year end something bad happened, any natural calamity or any accidents happened, and you lost your assets, but it is a non-adjusting event unless it creates going concern issues. What is a going concern, Elvira? Going concern is the assumption that your business is
You'll
continuing
continue always.
one more year, right?
Mm-hmm.
Okay, so if anything that happened actually questions that going concern concept, then the FS needs to be questioned and amended. Clear, no?
Mm-hmm.
Okay. Now, entering into significant commitments or contingent liability. So, when you're going to enter into a significant commitment, or you have a big sale happening, or you have a big liability that is going to rise after the year end, still, so it is not an adjusting event, but you have to keep it as a non adjusting event and give a disclosure note on it. Clear, no? Next
Mm-hmm.
is commencing a court case arising out of events after the reporting date. So after the reporting date, something happened and a court case is to be pending upon it. Okay, then in that case also, it is just a non-existing event. So you're going to give a disclosure over it. Clear, no?
Mm-hmm.
Okay, now we'll discuss this question, okay? Just give me a minute. Just a moment, Elvira. Okay, sorry about that.
It's okay.
ഇടി പൊട്ടത്തി ത്രീ പിന്ന് കുത്തിയിട്ടാന്ന് കുത്തണ്ട് കുത്താണ്ടാന്ന് ഉപയോഗിക്കണ്ടേ നേരിട്ടിട്ട് ഞാൻ മറ്റേ തന്നെ ഉപയോഗിച്ചു ഓക്കെ ഇനി ഞാൻ എടുക്കേ ഞാൻ ഇതാക്കേ recording. Okay, let me say it again. Okay, so
No,
there
I
is
was. Mm-hmm.
five-step revenue recognition approach. This is very compulsory for you to study. So the first one is identifying the contract. That means you have to identify what your contract says. Okay. The
Mm-hmm.
second one, that is whatever you are going to agree with the customer, whatever you're going to offer, whatever the customer is going to offer. Clear? So everything should be identified. the mode of transaction, whether it is a cash payment. Clear? Second one is you have to identify and separate the obligation that is to be performed by you and the buyer or the customer. Clear, no? So, for example, if I'm selling electronics, then that means I'm going to give them the electronics and they are going to give me the money. Clear? The third one is when you have to decide a price upon it. Clear? The fourth one is when in accounts there is no free or there is no offer. Okay, so whatever is being given for offer or free or discount, you have to account it some way. So you're going to allocate the transaction price to the performance obligation that you're going to meet. Clear? And lastly, the fifth one, you're going to recognize the revenue only and only once the performance obligations are met. You're going to record revenue only once the electronics are sold. Clear, no? You can't
Okay.
anticipate and record it. That's all. I'm going to pause you.
Yeah.
Going to identify from this illustration, all right? So on first December 2001, that company received an order from a customer for purchase of a computer plus technical support for 12 months, right? So 12 months is the contract. That company delivered the computer. So the computer was delivered, okay, on 1st December itself, right? The customer paid a total of $420 immediately, okay, which comprised 300 for the computer itself, but the 120 is for the technical support. Understood? Okay. So both the computer and the technical support could be purchased separately. That means they have a separate the purchase price for both of them, right? That company has an accounting year end of 31st March 2002. So the problem here is the computer, okay, it is an electronic device. Once it is given, you can recognize the revenue. The problem is with the service. The service is spread for 12 months. Understood? So you have to time apportion the service and recognize the revenue. Understood? Just like depreciation. Okay. So out of the 120, you can only recognize from 1st December to 31st March. Understood? Okay, no? So let's see. So the step one is identifying the contract, and the contract is the agreement between that company and the customer for provision of supplying computer and the services for 12 months. Clear? Step two is to identify two performance obligation that is with the contract. That is, they have agreed to give the computer and the computer is going to have a technical support for 12 months. So that is the performance obligation. That means you have separated it out. Clear? The product is not taken as a whole, it is separated out. Clear? Now the step three is you're going to determine what the transaction price is. Here they have already given you that is 420, right? But this 420 is not a normal price because it involves offers, discounts, etc., which you would study in detail in the next level. Clear? For this level, you don't need that much. Okay. Step four, allocate the transaction price to the separate performance obligations in the contract. So you're going to take 300 and take it as a revenue, but from the 120, you're going to time apportion it. Clear, no?
Because it's
Yeah.
revenue for 12 months, so it's like
So the 420 is not the price of the whole goods, but you know that the 420 is divided into two, 300 and 120. Okay, so that is the step four, 300 and 120. Clear, no? Okay, that is you have
allocation is this
allocated the
one, right?
transaction price. Now the fifth one is where you're going to that means you're going to time apportion it. Okay, so 300 is taken as a whole, but for the 120, you're going to time apportion it for 4 months. Clear? That is December, January, February, March. Okay, that is into 4 by 12. So together, your revenue for the year becomes only 340. The rest is to be recognized in the next year. Understood? Okay. Now, see, every business differ in its operations, right? No business is alike. Okay. So the revenue has made you a concession for it, or the standards has given you some instructions for which your business can use it, right? Okay, depending upon your transaction. Okay. So there is a provision as a revenue could be recognized over time. Clear? Over time means as and when the obligation is met, you can recognize revenue. Clear, no? So there are many types of revenue. The first one, customer is going to simultaneously receive and consume the benefits. For example, hotels. Clear? Second one, So then at that time you can record the revenue, right? You have ordered a customer has ordered the noodles. You're going to deliver the noodles. The revenue is to be recognized at the same, that is simultaneously, right? Second one,
Mm-hmm.
the entity's performance creates or enhances an asset. For example, work in progress that the customer controls as the asset is created or enhanced. So you have given a contract for the civil engineer to construct your building, right? So
Mm-hmm.
as and when the building is constructed, or for example, you are a construction company and the client is there, they have to build a building, right? So you're going to build the building. Would you wait till the building is completed in order to recognize your revenue or to get the payments? No, right?
Mm-hmm.
So as and when the building structure is being formed, you would get the revenue from the customer, right? So
Mm-hmm.
that is the thing that is here. Okay, it is called as work in progress. Understood?
Mm-hmm.
Next is the entity's performance does not create an asset with an alternative use and to the entity, and the entity has an enforceable right to payment for performance completed to date. The C is the bespoke things that you order. Okay, bespoke means it is personalized for your own use. Clear? Okay,
Mm-hmm.
so you have to give an advance if you have looked towards it. If you're going to tailor your dresses, that dress
Mm-hmm.
couldn't be worn by someone else, right? So you're going to
Mm-hmm.
give some advance for them, right? So that
Mm-hmm.
is here. Okay. So any personalized products that you're going to offer, you can recognize the revenue as and when it is completed. Clear?
Mm-hmm.
Okay. So there are certain cases where revenue is not over time recognized, but it is recognized at some point in time, right?
Mm-hmm.
Okay. So at that, what is the point of time you can actually take the revenue into your hands? That is when the control is passed. Clear?
Mm-hmm.
Now, there are different types of controls. Okay. So the first one is that the entity has a present right to payment for the asset. Okay. So the
Mm-hmm.
entity is going to have the right so that it can pay for the asset. Then there is control. Clear? Now, the
Mm-hmm.
second one is that the customer is going to have the legal title to the asset. Then the control obligation is met. Clear?
Mm-hmm.
Next is the entity has actually transferred the product to the customer, then the entity can realize the revenue. Clear?
Mm-hmm.
Next one, the customer has significant risk and rewards of ownership of the asset. So next one is that when while the product is being made, the customer is going to bear all the risk and reward for it. Clear?
Mm-hmm.
Next one, the customer has accepted the asset. Now the customer has accepted that this is my product. Okay, so you can sell it to me. Then that also means that you can record the revenue. Clear now? Okay.
Mm-hmm.
Now, IFRS 15 requires you to take certain disclosures into accounts. Okay. So, according to IFRS 15, what are the disclosures? We are going to discuss about it. So, the first one is the accounting policy for the revenue recognized should be disclosed. So, whatever accounting policy that you have come up with, you have to give it in notes to accounts. Clear? Next
Mm-hmm.
is while you were recording, you could have taken many significant steps or significant judgments regarding the five-step approach that we have discussed, right? So you have to keep it down or write it down. Clear? The last one is whatever total amount of revenue is recognized, how it is being broken into significant categories, you should also disclose that. Understood, no?
It's who needs to do this stuff? Accountant or?
Accountant. Accountant is the person who is responsible for doing this. Clear?
Mm-hmm.
It said that, okay. So, TYU 4, during the year ended 30th June 2004, I'm going to mark the year end. Okay. Always mark the year end. AMS
Mm-hmm.
company agreed to sell. So you have three cases. The first is here, 2 and 3. Clear? And you
Mm-hmm.
have 4 questions. Okay. Let's see. So AMS company agreed to sell goods to customer A. Okay. The
Mm-hmm.
goods were delivered on 20th June 2004, okay, at a price of 1000 plus sales tax of 20%. Clear?
Mm-hmm.
So here there is sales tax. Remember the equation? NSP is always 100, remember?
Yeah, yeah, yeah.
And sales tax plus GSP. sorry, say GSP minus sales tax becomes NSP. Remember
Mm, yeah.
that equation we need here. All right. So let's see.
Mm,
The cash was received from customer on 31st July 2004. Okay. So in relation to that requirement, what is the requirement? How much revenue can AMS company recognize in its financial statements for the year ended 30th June 2004 in relation to transaction with customer A? So customer A's goods for all delivered, right?
1,000.
Yeah, so 1000 plus the sales tax. Now, you can't
Mm-hmm.
recognize sales tax because it is a liability. It needs to go, right? So
Mm-hmm.
they have already given you. It is 1000 plus more of the sales tax, right? So
Mm-hmm. So
how much are you going
liability
to recognize?
also will go same period, right?
Yeah, it is
Mm-hmm.
within the period itself, right? So you're going to recognize that 1000 as a whole. Understood?
Yes. Mm-hmm.
Okay, no?
Yeah.
Next one. Next one.
Mm-hmm.
AMS company agreed to sell goods plus a 6-month maintenance agreement to customer B. Okay. So it is a
Mm-hmm.
6-month maintenance agreement to customer B with a total price of 1500. Okay.
Mm-hmm.
If the goods and maintenance contract was sold separately, it is how much? 900 and 600 respectively. Understood?
Mm-hmm.
The
Mm-hmm.
goods were supplied on May 2004. Okay. What is your year end? 30th. Clear?
June. Mm-hmm.
Now, and the maintenance contract commenced on that day. Customer B paid the maintenance contract, maintenance total amount due plus 20% sales tax on 15th July 2004. So your problem is you can take 900 as a whole, but the problem is with the 600. Understood?
Mm-hmm.
Okay. So from the 600, can you take the whole?
No,
No, right? Because you can
because
take
it's
from May till how much period? Till 30th June 2004. Understood?
oh,
Okay,
so
so
it's like
May, June.
two
It is
months.
two
Yeah.
months. Understood?
Mm-hmm.
And it is by far how much time period is or what's the time period that is being consumed? 6 months, right?
Six.
So
So
out of
out
the
of
six, it
six.
becomes 600 into 2 by 6. Clear, no? So
Mm-hmm.
together, how much could it be? It's 900 plus 200, which is 1100. Understood?
Mm-hmm.
Clear,
So
no?
we will recognize only the 2 months period for the
Yeah,
service because, yeah.
yeah, exactly.
Mm-hmm.
Understood?
Mm-hmm.
Okay. So
Can you
next
please this
is,
one make me screenshot also?
yeah,
Just
yeah, I'll send it to you. Or you can just look into the recordings. Just a moment. So here, the recognized revenue is to be given here, all right? Okay. They have
mm-hmm.
two questions. What is the revenue that is to be recognized? What is the trade receivables that is to be recognized? Clear?
Mm-hmm.
Understood?
Mm-hmm.
Both are different, right?
Mm-hmm.
Okay. So in the sales tax chapter, I have said the revenue is actually they are asking NSP. Okay.
Mm-hmm.
Are you? Just a moment. Okay. So previously I have written the 1100 here. I have moved it to 1100 here because the revenue recognition question is C. Clear?
Mm-hmm.
Okay. Now,
Mm-hmm.
what is the C question, B question that is asking you? What was the amount included in trade receivables, right? So revenue is what? NSP. Okay. So when there is a sale, how do you record this? You're going to debit revenue. Sorry, not revenue. Debit trade receivables.
Mm-hmm.
And you're
Credit
going to
revenue.
credit revenue or sales. And you're going to credit the sales tax, right? Because it's a
Mm-hmm.
liability. Understood?
Mm-hmm. Mm-hmm.
Okay. So say trade receivable would have both of them together. That is the tax and the revenue. Understood?
Mm-hmm.
Okay.
Yeah.
So you need to
Okay.
further give a 20% sale tax also. Clear?
Yeah.
Okay, so the total amount due plus 20% means how much is the sales tax?
1,200.
That is 1,200. Understood, no?
Mm-hmm.
Clear?
Yeah.
Okay, the same equation that I have taught you before. The same
Uh,
thing.
yeah.
Okay, and tax percentage is given. You're going to take the amount given into what to find divided by what is given. Clear, no?
Mm-hmm.
To find the GSP. Okay,
Mm-hmm.
gross selling price. Understood, no?
Mm-hmm.
Next is D. What is D asking you? It can be from this scenario. Let's read. AMS company acted as an agent on behalf of another entity to arrange the sale of goods to customer C. Okay. The goods were delivered to customer C on which date? 25th June 2005 at a total price of 600, inclusive
Mm-hmm.
of sales tax of 20%, they are saying. So if it is inclusive of sales tax, then that
It's
means it's
inside
got,
of 600. Mm-hmm.
yeah, that means it includes the sales tax as well, right?
Mm-hmm.
Clear. So that is a GST that is being given to you. Okay.
Mm-hmm.
But the problem is AMS company is an agent, right? So what's the problem with agency? See, suppose there is a company, Nissan Motors, right? A manufacturer.
Mm-hmm.
But do Nissan Motors sell the goods to you directly? No, right? They
Mm-hmm.
have agents or retail businesses in order to sell their products, right?
Mm-hmm.
So this agent cannot recognize the full revenue from the cars that they sell. For example, let's say $100,000 were collected for one car. But this 100,000 belongs to the Nissan Motors and the agent only gets a commission of 20%. Understood?
Mm.
So the same logic happens here. Even though the total price of the goods is 600, they can't record 600 because it is only a commission that their revenue is, right?
Mm-hmm.
Okay. But the problem is here it is inclusive of sales tax, right?
Mm-hmm.
Okay. So you
Mm-hmm.
have to what? Inclusive of sales tax means it is GSP being given to you. Clear?
Mm-hmm.
Okay. So what did I say? NSP plus ST is equal to GSP, right?
Mm-hmm.
Okay. And NSP is always 100. Clear? GSP is how much? It is going to be 120. Understood?
Mm-hmm.
Just a minute. Just a minute. Okay. So it is 120. So
Mm-hmm.
amount given to you is 600. Amount given is 600. Okay.
Mm-hmm.
600. So what is the, you need the revenue, right? First of all, you need the revenue. So
Mm-hmm.
revenue is equal to amount given 600 into what to find is 100. Clear?
Mm-hmm.
What is given is 120. That is GSP is given to you. From this, you could get the total revenue to be given to the parent or to be given to the principal company. Clear? So 600 into 100 by 120, 100 by 120 is 500, right?
Mm-hmm.
But you can't record 500 because out of that only 10% commission is for you, right? So 500
Mm-hmm.
into 10% becomes 50. Clear now?
Mm-hmm.
Understood?
Mm-hmm.
And with that, this chapter is over. Okay?
Mm-hmm.